What's going on, guys? Marco Trades here. Today we are looking at the Nasdaq, and this is my first trading day on my Express account. So there's relative lows below the price. We have some clear buy side above the price and the two opening prices. So essentially right now we are trading in a deep discount because we are beneath both opening prices and we swept some relative lows, and we also have some relative highs above the price. And right now you see me annotate the consequent encroachment of the opening range gap. This is not part of my model, it's just something I like to check just for additional insights. If you watch the 2024 mentorship, you know what I'm talking about. So right now I'm just basically waiting for an opportunity to go long. Price is in a deep discount. We swept some relative lows. We have some clear buy side above us. We touched the consequent encroachment of the opening range gap. Okay, all we have to do is sit on our hands and wait for a trade to happen. So right now we had some spooling higher. So I wanted to enter long inside that bullish order block on the 1 minute chart. ES was also spooling higher at the moment, and I'm annotating the opening price of that bullish order block. And at that specific moment we had a close under the opening price and under the mean threshold of that bullish order block, which is a bad sign. Essentially you don't want to see that happen. If we are really heavy to the upside to go higher, the price is going to respect these levels. And right now my stop loss is right below some relative lows. I don't really like that. You see me annotate the relative lows here on the 15-second chart. My stop loss is under that, so essentially I'm expecting the price to run my stop loss at any moment. We are 2 minutes away from the macro, and that's what I'm annotating here with this big gray box. It's just for visual clues. And ES is pulling higher, so I think I'm gonna add 2 more contracts, and I just did here, which was a mistake essentially. I should have not added 2 more contracts just because of ES was pulling higher towards the direction I wanted the price to go. But I did, and that's fine. Risk was still managed. As you can see, I'm retrading with small risk because today is just not it. So for the second trade, we had some spooling higher after I got stopped out, so I decided to re-enter long inside that bullish reverted gap, putting my stop loss under candle number 1 on the 15-second chart. So really safe stop loss. If the price got there, I just did not want it to be in a trade no more, so I accepted the risk, targeting the relative equal highs, and would just let that trade play out basically. So essentially you see the price respecting the upper half of that buy side and balance sell side efficiency. I like to see that, but I also wanted to see some spooling higher at that moment. Why do I like to see the price respecting the upper half of inefficiencies? It's because it's showing order flow, it's showing that it's really heavy to go higher for a bullish reverted gap or lower. If the price respects the lower half for a bearish reverted gap, then it's showing that it's really heavy to go lower. And you see me getting stopped out here for the second trade. So essentially I lost $216 for today on a day where I already had low expectations because there were no news release for today. And for the rest of the week, it's going to be also pretty hard because tomorrow is FOMC. So the morning session of FOMC is already hard most of the times, and next week is CPI and PPI, so you guys already know this one. So essentially I don't know if I will be trading this account really much for the rest of this week and next week. I would rather wait for a good week, you know, with good news release and good setups that are going to form, you know. So thank you for watching, guys, and be safe. Peace.